the bank.
Hey Brett, how's it going this week?
Good, Ange. How are you?
Good. Well, first of all, I am sorry, but happy Friday.
Friday? What are we doing here on Friday?
We're never here on Friday, I know, but life has been a little bit crazy for us. We have been basically in the north, the south, the east of this country, all over the place. We're finally settled. We're finally back at you. Even though it's a Friday, we wanted to get this out, and it is our 100th episode. Woo! Woo! If I was any type of real editor, I would insert, clapping, but I'm not, so thanks, Brett.
Nobody's going to hear that, all right.
Nobody's going to hear that. First of all, I was going to announce our winner.
All right, yeah. The big contest is concluded. Let's lay it down. Who is it?
It is Michelle.
Generic Michelle. All right. Anybody named Michelle, we're totally deceiving you, but one of you is a winner.
Michelle, well, there's only one. So on iTunes, you just leave your name, and you can type in any name you want. So we had some very fun ones out there. But Michelle, I think she put some numbers after it, like 99 or something. But Michelle, who left us a review on iTunes, you are the winner. And there was only one Michelle who left us a review on iTunes. So.
All right. So we will be reaching out to you directly. Is that how that works?
She will have to reach out to us because...
Oh my gosh.
I cannot pull her information from iTunes myself.
This whole system is fantastic.
It is.
Come on, Michelle, podcast world.
Reach out to us. We will send you your $100, and we are very excited for you. So thank you for being a listener for all these years. We appreciate you, and we hope you appreciate $100. With that, Brett, are you ready for your trivia question? Because we can't have the 100th episode without a trivia question.
We could.
No, and in fact...
This could be the new dawning of the age.
Several reviews actually mentioned that they would really like to see you getting some more questions correct here.
Well, then maybe I should start making them.
So, what percentage of credit card holders in America carry a balance from month to month?
Like that aren't paying off their credit card at the end of the month?
Correct. So every single
all
month.
of them. So let's just say 70% to be conservative.
60%.
No way. I don't believe it.
So what I think you're forgetting is think about how many credit cards people open and then never use. So it's like they go to...
I feel like that doesn't happen that often, except for everybody that's on all the credit card sites.
Because everyone has 20 accounts. You go to Macy's and they're like, do you want this credit card? And they open it and they use it one time and then they never use it again. Mm-hmm. So you just have 5-year-old credit cards out there.
All right. Well, par for the course.
Yeah, par for the course.
Not even close.
Well, you were within range. All right. So this is going to be kind of a fun episode. We are going to talk about a personal finance tip that I've seen on the internet that I don't agree with. So I think this is all really bad advice, but there are some financial gurus out there who think that this is really good advice.
All right. Yeah. And I think people have been trying to, debunk the celebrity financial advisors for a while now. And some of these things are on their list, right?
Yeah. So I'm not going to name any names, but these are some... You know who these financial gurus are, I'm sure. And I don't think they give very good advice all the time. I don't think a lot of them know how to do math. And so I'm just going to debunk some of this because I need to get it out of my system. So we usually keep it pretty positive over here on Money in the Bank. We're still going to keep it pretty positive, but we're just going to clear the air a little bit. So
yeah, and changing the pace. We've been giving you good advice for 100 episodes, and now we're going to flip the coin and talk about all the bad advice.
Yeah, because there's a lot of it. Okay, so number 1 is that you should have a very large emergency fund.
Woo! Pile on that bucks.
So I see this a lot where people think it's they're well, if having a 3-month emergency fund is good, then having a 3-year emergency fund would be better.
Right, or just a lot of common advice that you just see online is that you need to keep a year's worth of emergency or expenses. So that's the way it is.
Yeah, and so... Instead, I really think that 3 months of, your expenses is definitely good enough for an emergency fund. And I really highly encourage people to invest the rest of their money. So if you're sitting on a year emergency fund, I would just go ahead and take 75% of it and invest it. Because I think what people forget is even if you invest this money, it's not impossible to get it back out. Now, of course, you need to be a little bit careful because with the market, you're going to have, swings up and down. But at the end of the day, if you have a year emergency fund and then you have, let's say you lose your job, you have 3 months to get that money out. And you don't need to take 9 months out all at once. So you could take out, another 3 months. And maybe your emergency only ends up lasting for 6 months. So then you still have 6 months sitting there in your investments.
Right. And that's the worst case scenario where you're like single or maybe you have single income, sorry. Maybe you have dual income, but you have a kid or something like that, or more than one kid. So things might get a little more stressful there. But right, so it's all kind of a pliable, flexible situation where everybody's a little bit different. But we're just obviously the general rule of thumb is you don't need to overload that emergency fund just to be conservative, because in an emergency, you're putting this money that would just be in a savings account in an account that is still accessible to you, right?
Correct.
So if it is an emergency, then you need to withdraw that money, right? But if it's not like a year-long emergency, then you can leave that money out there, and that money, the longer it's in that account, that's an investment account that's just making more money year over year for you, then the less you needed to have that long term anyway.
Correct.
Right? So if I take that 9 months of my investment out of my savings account in year one and put that in an investment account, then eventually it's just gonna back its way up to all the extra money that I was gonna have.
Yeah, exactly. So, all right. Well, I think we covered that one. So number 2 is kind of on a similar token, but it's being conservative with your investments. And so a lot of people will say, make sure that you're investing to your risk tolerance, and you should to some extent. But if you're an extremely risk-averse person, it still doesn't mean that you shouldn't have any investments, right? So even if you're really risk-averse, the answer is to not leave everything parked in your savings account. It's to still invest, and maybe you only do 80% stocks and 20% bonds, or 60% stocks and 40% bonds, but you're still getting some exposure to stocks, and not individual stocks, but a mutual fund that has stocks. And you want to do this because otherwise it's actually riskier to not do this, because inflation is going to eat away at your savings. Right.
I mean, it's a riskier scenario to not invest because you're always against the grain. So you're always just going to lose money every year, putting yourself in a worse position, which is a riskier position, right? Because now you need to make a whole bunch of extra money on the front end from your income that you wouldn't have had to make otherwise, right?
Right.
So you're either working longer or you have to work multiple jobs, and you're just in a more of a stressful situation, which is worse than worrying about your money going up or down in the stock market. There's no such thing as a young person that should be not investing in this stuff, right?
Well, and regardless of your risk tolerance. An old person,
right?
So even if you're in retirement already, it doesn't mean that you should have 0% in stocks. It means that you should be closer to that 60% stock, 40% bond allocation that I mentioned. Notice that never goes to 0% stocks, and that's kind of an important distinction to make. And the other thing that I wanted to mention here is, so we've talked about compound interest a lot on this podcast, and if you invest your money into the stock market, you'll earn on average about 7% historically adjusted for inflation, which means your money will double every 10 years. If you do not do this and you just leave your money in a savings account, your spending power, instead of doubling every 10 years, will be cut in half every 20 years. Which I think is a really powerful illustration, because would you rather basically in 20 years have 4 times your money, or do you want to have half of your money?
Right. Starting with $10,000, do I want $40,000 or do I want $5,000?
I'll take 40.
Right? Yeah.
But that's just me. Okay, so moving on to the next one. This one is, I've seen this advice a lot, and it drives me up the wall. So there are a lot of financial experts out there who advertise paying down debt at all costs, even the cost of contributing to your retirement plan, even if you get a company match. So they will say, if you have debt, you should not put a penny into your 401k, even if you're giving up your employer match, which I think is ludicrous because no matter what your interest rate is, let's say you have high interest credit card debt that you're paying down at 25%. If that 6% that would go into your 401k pre-tax dollars that your employer might match 6%, that means you're getting 100% return on your money.
Right. Right. So if you don't have access to a 401k, it's a different story.
Correct.
Otherwise, you're applying an additional penalty to yourself.
Right.
Right? You could have had all this extra money, but you don't. So you have the debt coming in that you're trying to pay off, and you have the negative loss from the 6% that you would have had for free.
Right.
Right? And the loss on the money that you were going to make. Maybe that washes out with the debt from the interest rate that went into your 401k, blah, blah, blah. That washes out. You still lose out on the 6%.
Right, which you're saying 6%, but really that is 100% match to your money.
Right.
So you are gaining 100% right off the bat. You put in, let's say you put in $100 to your 401k, your employer gives you $100. You now have $200, right? That's an insane thing to pass up. And because you can contribute pre-tax dollars, that 6% that you're contributing is really only 4% of your paycheck. So by not saving that, you're only getting to throw an extra 4% at your debt, and that 2% is also lost.
Right.
So you're just throwing away money. I just think this is really bad advice. Now, if you are in extreme debt payoff mode, I do recommend that you drop your contributions to the minimum, especially if you have this high interest credit card debt. But once your debt is student loan debt or a mortgage or a car loan where your interest rate is going to be, less than 6%, then it really doesn't make sense to forego your retirement savings.
Right. And that minimum is whatever the company matches, right?
Right.
And that varies by company. Yeah.
Correct. So, okay. I think we covered that one. The next one I wanted to talk about is a lot of sites out there will say that you should always get a 15-year mortgage. And I think this is actually a really interesting one because we kind of did our own research on this recently. So historically, we have always gotten 30-year mortgages. And we actually just found ourselves getting a 15-year mortgage, but that's because we were buying a condo. And where we were buying a condo in Chicago, the mortgage company told us that if we were to get a 15-year, we only had to put down 20%, but to get a 30-year, we had to put down 25%.
Right, something like that.
And so we wanted to put down less money, keep that money invested for us, and go with the shorter term. However, for most people, putting down 20% for a 15-year and a 30-year, the break-even point is 7 years. So instead of giving this generic advice and saying everybody should do this, I think the real answer is to say, how long are you going to stay in a home? If it's 7 years or less, you should really consider a 15-year mortgage because basically you're going to be paying down that equity more aggressively early on. And so if you sell your house in 5 years, you've gained more equity that you can apply to your next home. If you're going to stay in a house for 7 years or more, you should do a 30-year and invest the difference, and you'll come out ahead.
Right. Yeah, because even with that penalty that was going to be applied for, condo, whatever penalty, it was still made more sense in our particular situation to get a 15-year mortgage.
Correct. Mm-hmm. Yeah, for us it did. But I think with that penalty, the break-even point moved from 7 years, which we probably would have gone with, a 30-year still at that point. But the break-even for us moved to 13 years. Mm-hmm. And I was like, well, for us, by the time we're at 13 years, sure, we'd be slightly better if we stay in this place for 15 years. But gosh, it'll be nice to just have a paid-off place at that point anyways.
Right.
So.
And again, some of that's financial advice and some of that's emotional advice because
definitely
it's super mentally a powerful thing to do to have a paid-off house versus 15 more years to pay on your mortgage, right?
Correct.
So since we were so close on that difference with that calculation, we were just we're just going to feel like superheroes at that point. So.
Well, and not to mention there's a good chance that we might stay in this place for 10 years and then we still made the right decision, or 11 years or 12 years. And so I was like, by the time we get to that 13th year, sure, at year 14, I'll be like, well, we made a slightly less optimal decision, but we're only a year away from having a paid off place. So that's a good consolation prize.
Right.
Okay, so moving on. The next one that I wanted to kind of mention is that you should always buy a house instead of renting.
Right. Renting is throwing your money away, right?
Yeah.
Because, you're never going to, you don't get any equity out of renting. So, yeah, I think we've talked about this one before.
We've done whole
we did a
episodes
whole
on
episode
this.
about
Yeah.
this one, yeah. This is a total myth because there's so many fees and so many hidden costs and so much money is dumped into houses that, right, it's much closer on the equation, if not depending on your particular situation and location, a worse decision to get into a house than it is to continue renting forever.
Yeah, so some kind of things to note here is it's always good to, there are a lot of websites out there that have rent versus buy calculators, and you can plug the numbers in for your city and location, which is a really good indicator to see it doesn't make sense to rent or buy. And another good thing that you can do is to kind of take a step back and think, what are my personal goals? How long do I plan on staying here? And really, if you're going to live somewhere for 3 years or less, it's a no-brainer that you should absolutely rent because closing costs would eat you alive, and you're going to walk away with no equity. Also, if you don't have a very large down payment and you're on a 30-year mortgage, you build equity very, very slowly. So Brett and I kind of mentioned, it's still hard for us to not pay down mortgages quickly, but we do have a 30-year mortgage on one of our rental properties that we've had for about 1.5 years now.
Oh, over 2 now, I think.
I guess close to 2 already. Time flies when you're having fun. But every year I show you like how much we've paid down on that, and like, so far this year we've only put down like $1,500 on the mortgage in principal. So like you build equity so slowly the first couple of years that like, if we were going to sell that, we wouldn't have a lot of equity to pull out of it. And if you don't put much down in the first place, you might actually owe more in closing costs than equity you have, and you go to closing thinking you're going to walk out with a check, and really you better bring your checkbook.
Right.
So it can be, and I'm not saying that to scare anybody, but it's something that a lot of people don't think about. And I was actually just talking to somebody recently, and they were like, oh, I finally saved up 5% to buy a house, and I'm so excited. And I just mentioned, well, did you know that as a buyer, you typically have closing costs that are 2 to 3% of the loan? And they had absolutely no idea. So that's kind of another area that can be tricky for a lot of people. That's an additional cost that people don't think about. So all these things are good to keep in mind when you're deciding to rent or buy. And it's funny because we've talked about how much we love renting and then we just keep buying. So, there are still a lot of good cases to buy a house, and we are homeowners ourselves.
Hey, we gave it a try in this area. We really were looking to rent for a long time, but the calculations were just not even close. And so that was the right financial decision for us to buy in this area.
It was. And actually our next episode, we are going to talk about our move to Chicago and the decisions we made, just because it might be interesting for listeners to hear our kind of thought process. So stay tuned for that one. All right, so then the next one I had is you should always pay cash for everything. Cash is king.
Right. No, don't use credit cards, only debit, only cash, right? It's all got to be regular transacted currency. And I've never been a personal believer in this one because I'm seeing all these like extra rewards that I'm getting, right? That, somebody else is paying for, right? So it's bad for businesses, but great for me. And the system's not changing anytime soon. So I might as well get my rewards out of it, right? But I've also been of the mindset that I do not ever pay 1 cent of interest debt on my credit cards. I get them paid off every month. That's how you use the tool appropriately. And then I just get all of these rewards from it.
Absolutely. So for 60% of people that have credit cards, they are not in the same boat as you. And we're not talking to you. You pay down your credit cards, okay? However, I think what's really important to keep in mind is that your regular spending, the spending that you're going to do anyways, should be put on a credit card. When you go to the grocery store, when you go to the gas pump, these are all great things to put on a credit card. And a lot of times, with different credit cards, you can get 3 to 5% cash back on all of these purchases, which is just money in your pocket or money in the bank, is what we like to say here.
Right. Well, yeah. Because guess who's paying for all that extra, fun givings that I get, all the rewards that I get? It's a 60% of,
right.
People that can't handle it.
And that's why credit card companies do it, because they get you in with these rewards. And then, you pay the interest back to them tenfold. However, it can be really good if you do pay it down because there's a lot of additional perks. You might get a $200 bonus just for opening a credit card. Mm-hmm. And so you shouldn't be scared of these tools. You should use the tools as appropriate. And by as appropriate, I mean don't rack up your maximum balance, stay within your limits, budget, do all the things that you're supposed to do, but then don't leave money sitting on the table.
Right. You don't want to, you can use the tool. You're exactly right. It's a tool. It's not evil. It's not a good thing. It's just a different vehicle mechanism that you can take advantage of. But as long as you never pay any of the interest on the credit card and you pay off that balance every month, then you're allowed to use it.
Right.
If you don't do that, you're not allowed to have it, right?
Right.
Because that's not how you use the tool.
Exactly.
You don't use the hammer from the wrong end, right? But debit is another one that's kind of risky, right? Because in today's age, if you go to the gas station and you swipe your credit card or you swipe your debit card to pay for something, and they've got a credit card skimmer in there, which actually happens quite frequently all around the country. If they get access to your debit card, that is far, far riskier than if they get access to a credit card. There's like 3 or 4 walls of protection between you and like losing out on that money that they would steal your credit card and get away with. If they get your debit card and they take the money out of your account and you don't see it for a couple days, I'm sure there's a limit of like $500 a day that they can withdraw from it. But if you're not paying attention like every day, or you're not getting alerted, or you're not looking at your bank statement, like they could walk off with like $2,000-$3,000 before you even like try to spend any money again.
So actually, I've had this happen to me when I was in college. Somebody did get a hold of my debit card somehow, whether I used it for gas or wherever, and they took $100 out of my account. That was never recovered. And especially in college, like $100 was a month of groceries for me. That was a lot of money. And so it was like really detrimental, versus the same thing happened to me a few years ago. My credit card got stolen and they took out $500, which was an even bigger loss. But luckily my credit card company, flagged it. They alerted me. Chase called me. I was able to explain that it wasn't me, and the charge just magically went away, and I was not on the hook for $500, where when that $100 was taken out of my account and the money was gone, there was nothing the bank could do for me.
Right. Money, so. It's like somebody stealing the gold bars from you, right? If it's gone, it's gone.
Yeah.
Right? There's nobody like holding the safety net for you using that model.
And the other thing I think is really interesting to mention about this is I feel like years ago there were a lot of places that were cash only, and while some of these places still exist, what we've seen popping up more and more in Chicago is like credit card only.
Yeah.
And I think it's for the same reason. Stores don't, if they, if somebody comes in and robs the store and takes their money, the money's gone. But if they only do credit card transactions, they're not at risk anymore. So nobody's going to rob that store unless they're like robbing them for the food they have.
Right. Your liability of injury and theft is down. You don't have to physically go take the cash register stuff to the bank. You're not counting all the money anymore, right? So you're just saving a lot of accounting time and physical delivery, right? Taking that literally coin purse to the bank to deposit it every day or every couple days, right? Like I don't want to walk down the sidewalk like however far that is with like $10,000, $20,000 in like an envelope in my pocket, right?
Right.
Like, that's just asking for trouble. But right, so moving into an all digital pay system, right? That can just make sense on paper for a lot of business owners.
Yeah, absolutely.
And a lot of farmers markets, I've seen like some vendors are doing that now too. They don't want to deal with cash either.
Right.
So.
And it's germy, so there's that too.
Right? Yeah, all money has what is it, cocaine on it or something like that.
Yeah, don't get sick. Use your credit card. Okay, so moving on, the next one I wanted to mention is that you need to improve your credit score by only paying the minimum on loans and credit cards. I don't know where this myth got started, but there is no penalty for paying more than you need to.
Paying on your credit card debt?
On your credit card or on your like student loans or even on a mortgage, it is very unlikely that you have a prepayment penalty clause in your loan.
Right.
You might want to double check your loan documents, but credit cards, loans, if you prepay them early, it does not hurt your credit card. I think where this came from is when you close an account, your credit age will slightly lower. So let's say you've had student loans for 5 years and you pay them off, that drops off your, credit history. So maybe you opened a credit card 4 years ago, your, credit history goes from 5 years to 4 years. That might hurt your credit score a little bit, but you're also going to get a gain for not having that debt anymore. So I know I paid my student loans off early. I've paid credit cards off in full every single month, and I have a very good credit score. So I definitely don't think my credit score would be any better had I kept this balance for years and just paid the minimum.
Yeah, there was a clause in one of the paperwork that we had to sign for buying the condo, and that said, right, it was an early on disclaimer that said your mortgage company, like, you know, retains the option to, you know, penalize you if you pay extra or something. I saw that on one of the pieces of paper, but yeah, we have never actually had a mortgage that actually enabled that or used it.
Right. And so actually in the final wording of ours, it said that we do not have a prepayment penalty on our mortgage.
Right.
And that is what we have always signed for the final durations. The student loans I had were, you know, through the federal government, and I had no prepayment penalty on those either. So there might be some out there if you're with a private company, maybe they don't want you to prepay, but it is pretty rare, and it definitely doesn't hurt your credit that much, especially to just pay down your debt and pay it off faster.
Right. It's super insignificant compared to all the other metrics that go into your credit score.
Yeah, and it's far better to just put a little bit on your credit card every month and pay it off in full and get into the routine of that anyways.
Right.
So you're still getting charges on it every month, you're still paying it every month, you're still building that good credit payment history, which is more important.
Right. Again, another reason to not stay away from credit cards if you don't have to.
Correct, yeah.
Just use them appropriately. Don't use the wrong side of the hammer.
Okay, so then the next one I wanted to mention is that you must get a college degree to get anywhere in life. We've also talked about this a lot.
Yeah, this one's the controversial one, right? Because everybody wants to believe, especially in America. I don't know if this is necessarily true in the rest of the world today. But, right, when I was growing up, when you were growing up, that was the thing, right? Everybody was pushing for, you got to go to college. That's the only plan. You know, even like technical trade schools were like looked down upon at that time.
Right, and now all of our trades are dying. So
right,
fancy
yeah,
that.
Great. Now like all the
like literally dying. Everybody in the trades is getting old and dying.
The average age of all the plumbers is like over 60, and right, yeah. So yeah, it's just a terrible situation. We need all those guys. Those are great things to do. The dollar amounts people are getting in those industries are like over $100 an hour for most, you know, calls and stuff like that. You know, so there's no loss of funds for any of those fields. Doing, you know, even if you're like an electrician that has to like climb telephone poles, like they pay you for all the training that you need to do to go do all that stuff for like 6 months while they're training you, and then you make like a ton of money at the end of the day. You like start at 80,000 or something.
Yeah, and you know, I actually just met this, I shouldn't say kid, I think he's in his early 20s now, from the South Side when I was down there volunteering, and he is a carpenter. And so he started like learning carpentry when he was like 9 years old with his uncle. And when he graduated from high school, instead of going to college like his parents wanted him to, he kind of followed in the footsteps of his uncle instead. And he went to trade school, learned carpentry, joined the union, got a good paying job, decided he wanted to do other more creative things. And like basically he could write his own ticket because his skill set is in such high demand that he can do whatever he wants. Mm-hmm. And especially like in big cities, if you're a contractor or a builder or you're a carpenter, like you will not be without work because there's so much construction always going on in this city and they do not have enough hands on deck. I actually saw when we were living down in Orlando, I saw something basically saying that like building projects were, like construction projects were taking so long because they could not find enough qualified builders. So, I mean, builders, plumbers, electricians, HVAC, all these trades are in such high demand. And we've said that so many times on this podcast, but I do think it's really important when you're in high school and you're figuring out what you want to do with your life, take a step back and look at the end goal and look at the job market and say, you know, what are the jobs that are in high demand? Which ones of these could I qualify for? Some of them are going to require a college education. Some of them are not. And either way that you go, you can do really well for yourself in life.
Mm-hmm. Yeah. So, I mean, we did did we do a whole episode on this? I feel like we've talked about it at least 3 or 4 times.
We've talked about it a lot. I don't know if we've dedicated an episode to it, but definitely talked about it a lot. And I know it's kind of controversial, but
so the times they are changing. So
that's right.
Right. Paying a ton of money to go to college now. One is getting to be offensive. It doesn't need to be that expensive. What you're getting out of it at the end of the day from a skills perspective is like not as good as what people used to rack it up to be for what it costs, right? So there's
Yeah, the
better
ROI is just
alternatives.
not there anymore.
Yeah.
So
either the schools need to come down in price, or what you get at the end of the day needs to be worth a lot more.
Yep.
And right now the equation is just off balance.
Absolutely. Okay, so then the next one that I wanted to bring up is you should invest in stocks and you should really try to buy the next Apple.
Oh, individual company
Individual
stocks?
stocks, you know? I mean, why not you? If Joe Schmo down the road made $1 million off apples, apples, selling apples, off Apple stock, buying it, 30 years ago or whatever, why can't you pick the next great thing?
Well, even Apple stock like 10 years ago. I was talking to my coworker the other day, and he said his brother just made a fortune when Coke changed their formula back in whatever that was, the 70s or 80s or whatever, where they went from like old Coke to new Coke, and everybody hated new Coke. So then they went back to old Coke. Like he just like timed their stock just right and just like made like it tanked when they brought out new Coke, and then they switched back to old Coke and it just like skyrocketed, and he just like invested everything he had into it and just made a fortune, right? So who doesn't want to be that guy?
Right.
But
what you don't hear about? The people that did the opposite.
Right. The other like 90% of people that were just like, this new Coke thing is going to take off like gangbusters, and invested everything. And then it dropped down to zero and they're like, oh my God, I got to pull my money out.
Right.
Right. Or best case scenario, they got even and got lucky. Right.
Or living in Michigan. I mean, growing up, I knew so many people, or not, directly, or, my friends' parents who invested in GM or Ford. Mm-hmm. And then, like, literally that stock went to zero, too big to fail, had the government bailout. It was a huge disaster, never really recovered. And so, there's a lot of people I know in Michigan that are scared of investing because of that. And they're like, well, it never recovered. And I was like, well, that's just because it was a single stock in a single industry, which was automobiles, which blew up, right? Mm-hmm. And the beauty of investing in mutual funds is you're invested in the auto industry, but you're also invested in a million other industries,
healthcare,
real estate,
tech,
healthcare. Yeah. Named a bunch of different ones. And food, it's great. So it's so much better. It'll cushion the blow. You're going to have good times, bad times. You just invest, set it and forget it. And that is totally the right strategy.
Yep.
So we've done 4 investing episodes, which I highly recommend listening to.
Right. And like we said in some of those, if you're going to invest in that stuff, you think of it as like play money or gambling money. You set that aside. That's not for your investment funds. It's for, right, it's just for, for the sake of it, right? If you're going to invest in a company stock, do that with money you're not worried about losing. Because there's a real good chance it's going to disappear.
Yeah.
Same with Bitcoin. Same with poker. Same
with Mr. Money Mustache's fingernails.
What?
You've mentioned Bitcoin, and so, anyways.
Yeah. What?
There's Mr. Money Mustache had a whole article about this that I highly recommend you read if you're curious. But it was basically just like he was like, well, if this thing is inflated, then why not my fingernails?
Wow, you should have saved that for one of my trivia questions. That could have been a doozy. I would have got it right just as much as the rest of them. All
right, so on to our last point. Here so this is kind of an interesting one. This is one that's kind of, I feel qualified to speak about because I know a lot more about life insurance than the average bear. But a lot of gurus out there will tell you that you should sell your whole life insurance policy and instead buy a term policy. Now, this is bad advice for a lot of reasons. Now, first of all, you want to make sure you're assessing your insurance needs. And so, there's a good chance that if you have kids, then perhaps you want a term life policy that is much higher in value for, maybe the 18 years while that kid's around to pay for costs should something happen to you so that they can be raised.
So, hold on. So a term life policy is a finite short term.
Correct.
It's only going to last for like 3 years or 10 years or something like that.
20 years, yeah.
So I buy it today. I'm paying on it for 10 years. The insurance coverage is good for the 10 years.
Yep.
And then it disappears and it's like I never paid for it before. It just poof, goes away.
Just gone.
Whole life is you invest in it over a period of time. That could be 10 years. That could be 20 years. But then you have that insurance forever, right?
Right.
And so, right, so you get to hold on to it. So that's why, to me, that seems a lot more advantageous.
Yes. Well, like I said, there's different strategies. So, let's say you have a kid and maybe you want $200,000 in insurance because if something happens to you, you want to be able to pass that along to a relative who's going to help raise them. Now, if you were buying a $200,000 term life policy, you're going to pay far less than if you buy a $200,000 whole life policy. And maybe you don't need $200,000 of insurance for your entire life, right?
Sure.
So a lot of people who buy whole life, maybe you go with $50,000 or $100,000 because you're basically buying it so that when you die, the cost of your funeral is covered, the cost of any maybe remaining debts you have are covered, or perhaps as you get older, there's some interesting strategies you can do in the nursing home with it. So you need smaller amounts. So there's different purposes for different tools. Kind of as we mentioned, everything out there, finance-wise, is a tool. These are both valuable tools to have in your toolbox, but they serve very different purposes. Now, another reason I really caution against, if you already have a whole life policy, especially, let's say you bought one 10 years ago. Now, whole life policies are mostly front loaded. So you might only pay on it for 10 or 20 years and then you never pay on it again. So if you sell it halfway in that you've already paid on it, well, you're almost there. You've almost made it. Also, the other advantageous thing about a whole life policy is you have an account value tied with it. So every time you make an annual payment, it goes to your account value. Your account value grows at some interest rate. I actually have one from when I was like age 0 that is guaranteed at 4% interest, which is not as good as the stock market, but not as bad as a savings account. So it's kind of in the middle. And so these can be kind of a good way to save money. You can also take a loan out against them. So maybe, as I get older, maybe I want to buy a new car and I could actually take a loan out from my whole life policy. I don't have to go to the bank. I can just take it right out from there and I'll get a better loan interest rate than taking it out from somewhere else. So there's kind of a lot of unique ways that you can use these tools. And especially, my dad got for me when I was age 0, so I got a really good rate on it.
Yeah.
It was paid off by the time I was 18, and now I have it forever. If I wanted to add more money to it, I could. And, we actually got you a whole life policy as well when we got married, much for the same reasons that I had mine, but you just didn't have one yet. Mm-hmm. So
I knew nothing about life insurance whatsoever because, most of my family had not historically worked in life insurance like some other people.
Weird. What's that like? But yeah, so I think a lot of people have a lot of negative views about whole life. I view it as another tool that you can have in your toolbox. Now, I would never go out saying that everybody needs to have $100,000 or $200,000 of whole life, but getting 10, 20, 50,000 is probably enough for a lot of people. There's also a lot of really cool policies out there that you pay for a $50,000 policy and, over the years that you pay it, it'll double to $100,000 of coverage. Mm-hmm. So there's a lot of cool products out there. They're not all created equal. And I highly recommend if you are looking for a whole life policy, go to an independent agent. They will be able to compare quotes from multiple different companies. And actually, this is good advice for all insurance.
Everything.
Home insurance, auto insurance.
Car and auto insurance.
Both. Life insurance. Go to an independent agent. They can pull rates from different from different companies and find you the lowest rate. We actually just did this again for our home and auto when we moved to Illinois. And literally, we save 50% by just shopping around.
Yep. Yeah, the quotes that come back are, some of them are a joke and some of them are like very competitive. When we shop around with multiple brokers too, right? Because different brokers have different companies that they can work with too.
Right.
So we're playing the field and trying to hit like every single company and what they can offer. And you're going to get the best deal at the end of the day.
Yeah, and that can sound really overwhelming. So if that is too overwhelming, just start by picking one broker and get rates, and I guarantee you're still going to do better than going to a single company. And then if you want to take it a step further, maybe just do this on an annual basis, then try another broker and see if you can get cheaper. We basically review our home and auto insurance once a year or once every 2 years just to get new rates, and we usually end up saving money every time. It's amazing.
Yep.
Like eventually we're going to get to zero, right?
Well, the companies keep changing what they offer, and sometimes they have like deals or something. I don't know what they do in the background, but their stuff changes and we just have to follow up and just like renew our stuff and look at the best company, and it's different every time we look. So
yeah,
people just keep wanting to save us money. So.
All right, well, that is all I have on the list. So those are 10 myths that I wanted to debunk here today.
Yep.
For our 100th episode. So thanks to everyone who's been with us for all 100, or even if you just joined in at 99. We're so glad you're here.
That's right. And congratulations again to Michelle that may or may not have some numbers after her name.
Michelle 99, something like that.
Please, again, reach out to us and we'll be happy to contact you and send you your $100 gift card or whatever format we can figure out.
Yes. And we will be back to our regular schedule of Monday podcasts next week. And then potentially sometime soon here, we might try to ramp it back up to 2 a week because we really kind of have fun with like Wacky Wednesday. So
no, it's way normal conversation Wednesday.
Way normal Wednesday. All right. Well, thanks so much for tuning in this week. Feel free to send us any questions or comments anytime to Angie at moneyinthebankpodcast.com. And we look forward to being around for another 100 episodes.
Money in the bank.
Hey guys, thanks for tuning in to this week's episode of Money in the Bank. Make sure to subscribe to us on the iTunes or Stitcher app so that you get weekly alerts every time we post a podcast. Or if you want, you can visit my website, moneyinthebankpodcast.com. And if you want to reach out with any questions or further comments, please email me at Angie at moneyinthebankpodcast.com. I look forward to hearing from you.
Money in the bank.